Oh, sorry. Didn't see you there. I forgot. My name is Matt Luchin. I want to welcome you all to the G-Unit conference call. As you can tell, me and my friends 50 Cent were just listening to some of our fine rap beats. We had a plan of being a broad market player with an average SQ rating, basically no differentiation. And that led to some pretty mediocre results to begin with. We did desire to be low cost though, and that would help us in the end, but at the beginning it wasn't that great. It basically fell on its face. We couldn't get anything done, and everything started to fall apart. Our net revenues were down, our earnings per share were down, our return on equity was down, our stock price was down, our credit rating was terrible, and our image rating was the only thing that went up. And that's when we decided that it was time to take a different strategy. We went lowest cost provider, low SQ rating to begin with. From there, we decided to add special tweaks every single time. While most people would say you should have one strategy, we decided to continually differentiate ourselves so our competitors could never figure out exactly what we were doing. So first, we went to 3 and 2 stars from our 2 plans. Then, 2 and 1. We followed that up by increasing the number of models to eventually 500. At that point, we started to invest heavily in our celebrity appeal, eventually changing the entire game in the industry and coming up with unbelievable revenue gains in the end.
Right now, it is ugly times ugly. And that's when the ugly get going. Most people, when they lose, they whine and quit. But you got to be there for the turns. Everybody's got good luck, everybody's got bad luck. Don't run when you lose. Don't whine when it hurts. Nobody likes a crybaby.
Interesting point, Gordon. Although, I think you're discussing our initial setbacks and not our eventual successes. Our pricing was way too low. We thought a low SQ rating meant that we had to price low, but that's not necessarily correct. If you market correctly, we would be fine. So we were unable to price correctly, and we were not differentiated at the beginning, and that definitely hurt us. We were also overproducing because we weren't pricing correctly or even offering it to the right places at the right amounts. It just didn't work out. With the overproduction, we had surpluses, we had high inventory carryover. Nothing started out great. But Gordon, check it now. I lent you in Wall Street 1 a lot more than Wall Street 2.
Last week, my stock was worth twice what it is now. I'm thinking about getting out in a whole kit and caboodle of it, boy, unless I see a vast improvement.
Oh, Roop, I don't know what you're talking about. Talking specifically about our stock price, we did a couple different things to really get it going. In the beginning, you're right, it was $30 in year 10 and jumped and dropped immediately to 16. At that point, we actually bought some back. The following year is at 13. We knew we were in trouble. But then we changed our strategy, just as we discussed. And we started to creep up. 26 the next year, 32 the year after. The year after that, 38. This is when we started to make a little strategic decision here. We started to pay some dividends. First $1, maybe $1.50. Well, maybe just $1. So your $30 stock that you had in year 10 is now worth $188. Do the math on that one, Roop.
What you're telling me is that the music is about to stop, and we're going to be left holding the biggest bag of odorous excrement ever assembled in the history of capitalism.
96, 97, 98. Oh, hey, Warren. I think you're a little misguided there, but let's move on. Let's discuss our initial successes, which, to be honest, weren't many. We, as I said, we had a large presence in the internet sales. Actually, I don't even think I said that, but we did. We did well on the internet. We knew that this would be an important segment, mostly because we could get our highest margin on it. Moving on, we would always try to get our private label sales to guarantee the bid. The key with private label is if you're going to produce, you better win the bid. Now the problem is you're only making about $1 margin on each one. So in reality, you'd much rather use that production to sell in the wholesale branding region. And lastly, we had a leapfrog award. Yes, I told you we had some missteps earlier, but able to get a little 21-point jump, and that put our competition on note. We're coming for you.
I want you to get up now. I want all of you to get up out of your chairs. I want you to get up right now and go to the window, open it, and stick your head out and yell, "I'm as mad as hell, and I'm not going to take this anymore!"
Are you happy now? I'm wearing shorts. Get off me. Let's discuss the industry a little bit. We never felt anyone was directly our competitor. It was all about differentiation at a constant rate. Every single time we moved to make a new strategy, we first decided what will the industry be doing. We were very aggressive on our industry assumptions. The key to a good forecast is to get the industry assumptions correct. What we did was we would overestimate. Now, be overly aggressive in our assumptions. So we'd always lower the price. We'd always increase the star rating. We would always increase the brand and number of models out there. Let's do a quick overview of just our performance charts. Net revenue, I told you about the early dip, into an increase at the end. There you go. Earnings per share, same kind of game. You might see the expectation dots there. Oh, wow. Is this good? Return on equity. Look at that, baby. Stock price, as we talked about, the dip, all the way down to $13. 188 now. Celebrities. A big issue in the market. Undervalued. Ask TV. They did some analysis on it. We didn't. But what we did do was put aggressive bids down. Why? We realized fast that this was a great differentiator. Did you know, in the manual it says that if I have a celebrity with 50 points of appeal and you have one with 100, you're not 50 points better, you're twice as effective. That's important to know. I would like to thank our CMO, Michael Strom, for that idea. He knew from the beginning two things could be effective: celebrity appeals and free shipping. Unfortunately, he was incorrect about it. We tried to maximize production, and at the end we were actually buying capacity. While we knew that we were actually spending more to get the capacity, we knew that these sales increase would increase our market share, our revenues, our profits, and across the board. We worried less about ending cash because our credit rating was already A+. Oh, sorry. Still here? Sorry, I was reading 2 books at a time. Past time of mine, actually. Sorry, Mark Cuban again. No, Mark, I can't make it to your yacht club today. From the BSG Central, we had a top 100 performance in ROE and stock price. All a day's work. Me, Strom, Sampson, Richardson, we worked well together, we figured it out, we all had our roles, and at the end of the day, it seemed to pay off. I want to thank you for coming on to the conference call today. If any of you have any other questions, I'm sorry, because the game's over.
Think about that. It ain't about that. It's about Dutch, aka Big Shaq. Now that's the difference between first and last place. Kobe, tell me how my ass tastes.
That's it.